Hi traders, welcome back to the QuantQuest Academy. Today we are diving deep into the volatility in the options market with a real-world example for how implied volatility, which is IV, impact options pricing. We will break it down using Tesla options before and after an earnings season. This is crucial knowledge for everyone trading options. So make sure to watch until the end to see how to profit from volatility. What is the volatility? The volatility measures how much a stock moves. Some stocks like Tesla can swing between 5 to 10% daily. That's high volatility. Others like Coca-Cola barely move 1% in a week. That would be considered as a low volatility. For example, if Tesla jumps from 900 to 1,100 in a week, that's high volatility. But if it moves from 900 to 920, it would be categorized as a low volatility. Basically, the more volatility equals higher uncertainty, which makes options more expensive. Now that we got familiar with the volatility, let's break down the two types of the volatility traders must understand. The first is historical volatility, or HV. The historical volatility is based on the past price movements. For example, if Tesla has moved 5% per day on average over the last 30 days, so its historical volatility is high. But on the other hand, the implied volatility is market expectation of future price swings, which in the simple language means that the market expectation the specific stock, such as Tesla, most likely is about to has a big move, and that could be caused by earnings season or new product announcement. The higher the IV, the more expensive options become. That being said, when the implied volatility increases, the options premium rise, and when the implied volatility decreases, the options premium fall. Now let's go through an example. Let's say the Tesla 1000 strike call options usually cost $20 before earnings. IV spikes, making the same options cost $35 due to the higher uncertainty. But after the earnings, IV drops, and the options might crash back to $15. Even if the Tesla stock price didn't move much. Now let's go through the Greek words to see how it works with the implied volatility and how to measure the sensitivity of it. By the way, for those who are familiar with the Greek words in the options, then they know what I'm talking about. But for those who are not familiar with the Greek wording in the options trading, I have the full video that explains those Greek words for you, and you can learn how you could apply them to your daily trading options. The Greek words that we're going to talk about today is Vega. Vega measures the sensitivity to the IV changes. If an option has a Vega of 0.10, a 10% IV increases at $1 per contract, since options contract 100 shares. High IV inflates options pricings, while low IV deflates them. This is where the traders win or lose money. Now that we understand IV, let's see how to apply it in the real trading strategies. Buy options in the low volatility environment. For example, buying the Apple calls before a big product launch when IV is low. Selling options in the high volatility environments. When the IV is high, selling options earns high premiums. For example, selling cover call on the Tesla before earnings, collecting inflated premiums. using strategies to manage volatility risks such as straddles and strangles, profit from volatility spikes, whereas use the iron condor and credit spread when the volatility dropping. In conclusion, to maximize profits, buy options when the IV is low and selling the options when the IV is high. Now let's study how the IV affects Tesla options before and after earning, and break down the real trade example using the Tesla's earning with two scenarios. The scenario 1, Tesla before earnings. The IV is high. Date 1 week before earnings. The stock price is $1,000. Implied volatility is 80%. Options price Tesla $1,050 call for $45 premium. Reason IV is high, because traders expect a big move, and that makes the implied volatility high, which is 80%. Scenario 2, 1 day after earning. The stock price is $1,020, a small move, not much. Implied volatility 50%. Options price for the Tesla $1,050. The call option is $20. Reason IV drop even though the Tesla move up. And as you may realize, even that the IV drops to 50%, which is 30% less than the IV percentage before the earnings season announcement, but the premium price drops almost 56%, more than that it was before. And that's how the smart traders who understand the concept makes the most of it. Even though the Tesla's stock price move up, the options price collapsed from $45 to $20 due to the IV crash. This is why buying the options before earnings is risky unless you expect a huge move. So now you might ask, in that scenario, what would be the best strategy to use? Instead of buying the call when the IV percentage is high, traders should sell a credit spread or an iron condor to profit from the IV drops. Basically, high IV inflates options prices. So smart traders sell options before earnings to collect the inflated premium and buy them after earnings when the IV drops.
Alright traders, now you know how IV impacts the options market with a real-world example of Tesla's earnings. If you found this helpful, hit that like button, subscribe, and drop the comments below. Also, make sure that you check out my next video on advanced options strategies to hedge against the volatility risk. See you next time.